Welcome to the Money Mentors Podcast.
Remember, if you have questions for us about anything we discuss here on the show, we'd love to hear from you. You can submit your questions right there online. Drop us an email through our website at matsonfinancial.com. And our special series on taxes continues this week here on Money Mentors with a focus on Social Security. So how are your benefits taxed when you take those benefits in retirement? You might be surprised, actually, and not in a good way. Social Security income is taxed based on your income. Taylor, Laura, I think this surprises people, and it doesn't actually take much to hit those taxable thresholds, does it?
No, it does not. And this is one thing I see a lot when I'm working with clients is, wait, you mean my Social Security is taxed?
Right. That was what
it depends, but likely, yes, for all practical purposes. Most people are going to be paying some taxes on their Social Security. Now, the thresholds are pretty narrow. So if you are single and your income is below $25,000, no taxes, right? Okay. Now, if you're married, you're filing jointly, $32,000 is that threshold. Anything above that, you're going to pay taxes on some of that Social Security benefit. So let's go to the next one, which is 50%. And if you're single, making between $25,000 and $34,000, then that piece there would be taxable. And then $32,000 to $44,000 as a joint couple, 50% of your benefit is going to be taxed at your marginal tax rate.
And guess what? It doesn't stop there.
No, it doesn't.
Because now here comes 85%. So, right, when you earn more, you end up paying more in taxes. So with a provisional income of $34,001 and above for single filers, or $44,000 and above when filing jointly, 85% of your Social Security benefit will be taxed at your marginal tax rate. And so, looking at 2024 here, the top tax rate is 37%. So that's a lot of tax talk, right?
Yeah.
But just know, depending on what you're earning, right? That's why we talk about with clients, you really need to have some help, right, from an advisor from our team to talk about when should you actually file and start Social Security benefits, especially if you're working.
I think the confusing thing about this is we just threw out a lot of dollar ranges and percentages, but let's use the 85% range, for example. So if you've got $1,000 Social Security benefit and you're married and you're making over $44,000 and $44,001, then $850 of that $1,000 is taxed at whatever your marginal tax rate might be. It might be 12, might be 22. Then you double that if it's a $2,000 a month Social Security. Now you're talking $1,600+ a month that's taxed at that tax rate. And there's a lot of things that we can do planning wise to help avoid some of that. We've got to pay our fair share, right? But how can we do a tax plan appropriately during our working years to make sure we're paying as little tax on that Social Security benefit as possible, keeping more of that hard-earned money in your pocket? And it may not be even let's do Roth conversions or, switch our contributions. It may just be, hey, you're already taking your income. You're already taking Social Security. Let's shut off some of this IRA income, start pulling from that non-qualified account, or let's start pulling from that Roth. And that's why it's important to have that diversified tax bucket as well. Having that taxable money, the non-qualified, the tax-deferred, of course, your 401k, IRAs, and then that tax-free, and being able to turn the faucet on and off from all of those sources to run that, very efficient portfolio, but also when it comes to taxes.
And don't get surprised with a big tax bill, right? That's the worst thing is you're doing all of this stuff. You think you've got it under control. Here comes tax time. And then you're going to be hit in left field thinking, oh my gosh, my Social Security benefits were taxed. I didn't know that. And my advisor didn't talk to me or we didn't put a plan together. So let's change that conversation around and get way more prepared, be more proactive when it comes to your retirement income and taxation.
Yeah, and maybe it makes sense to actually withhold some of that tax from your Social Security benefit instead of being surprised at the end of the year. Maybe withhold 12 or 15% in federal tax from that Social Security. Again, so at the end of the year, you're not having this big tax bill, but review that with your advisor, with a fiduciary advisor, with your CPA. That's what we're here for, is to make sure that you're keeping as much of that hard-earned money as possible in your pocket.
Real life lessons about your retirement. You're listening to the Money Mentors Podcast.
Well, if you're 73 and up right now and pleased with your retirement account balances, know this, there could also be a downside here as well. CNBC points out that thanks to good market performance, RMDs will be supersized here in 2024. So any way to control the size of those RMDs as well.
It sounds like a really great thing, but it's kind of a bad thing.
Right?
So,
at this point, what's done is done, right?
Yeah.
Now, let's say that you tithe regularly to the church, or there's a couple charitable organizations that you like to donate money to. Donate your RMD because that's tax-free. You're not paying taxes on that. It counts towards your RMD distribution. That charitable organization is also not paying taxes on it. So if you're already doing that gifting, don't gift from after-tax dollars. Gift from that qualified account and, take advantage of that tax benefit. I mean, I've already seen in RMD planning for clients this year that they are sizable, bigger than what they have been in the past. And that's where, we can't change where we're at now, but looking at Roth conversions coming into retirement or switching your contributions and start putting some more of that money away into the Roth 401k or Roth IRAs, or even that after tax account to start diversifying those tax buckets. Because again, this is a big factor into what we just talked about, which is the taxability of your Social Security, right? Mm-hmm. Not to mention, is it going to bump you up to the next tax bracket?
Exactly, because RMDs are taxed like regular income. So you get this larger distribution. Now you're bumped into a higher tax bracket. And you can't really control it at that point.
It could have been $10,000 last year, and this year it's $20,000, and that every single penny of that $20,000 is now taxable to you. And so, knowing where to pull that money from, but also if you're in a position now, we are in a new year, we're in a presidential election year.
Have to remind us.
Sorry, I didn't bring that up, but we were already talking about taxes, so let's talk politics too, right? So, but the point being is, we've already got that money that we have to pull out of the account. And I had talked to earlier segment about harvesting some of those gains. What would be even worse is you have to take that larger RMD and then we have a mid-year correction or a big correction at some point throughout this year. And now you're pulling out more money on a portfolio that's worth 10, 15, 20% less. So if you do have that, let's start making a plan for that money now, because at the end of the day, you've got to take it. But what I don't want to do is see the market take that away from you and then you add insult to injury, and now you're pulling out a large RMD at a loss plus taxes, right? So planning for that.
Another place where strategy really comes into focus here. And as I was reading this story too, I was thinking, we were talking about how many people don't know their Social Security benefits are taxed. A lot of people may not know even that the RMD age has changed in recent years. I mean, again, they're just constantly kind of changing the rules on us. It's almost like they want to trip us up. I don't know.
Oh, I think so.
I think for sure.
Right?
It's so confusing because it went from, 70 and a half, then you're jumping all around.
It's the current year, next year.
Right.
That was and then it was 72. Oh,
yeah.
This is great. Very easy.
Boom, 73.
Yes. And now, but maybe 75.
Right.
It just depends on your birth year.
Exactly. So just know that the rules are changing, but that's why it's so important for you to work with somebody who's knowledgeable about all things retirement, like we are here at Matson Financial. And when it comes to RMDs, like you'd mentioned, Jennifer, it's 73 right now, and that will change in the future. But if you're one of those individuals where you were a part of the 72 before or the 70 and a half, you have to stay in your lane. You're grandfathered in your own age. You don't get to stop and then start back up at 73. So you're locked into where you started.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Fee-based financial planning and investment services are offered by Matson Financial Services, LLC, an SEC-registered investment advisor. Insurance products and services offered through Lakeview Financial Group, LLC, Matson Financial Services, LLC, and Lakeview Financial Group are affiliated. To find out if Matson Financial Services is licensed in your state, please call 800-536-8907.